All right. Well, hello and welcome to this evening's AAII Growth Investing VIP webinar led by Wayne Thorp and moderated by John Bajkowski. Thank you so much for joining us. We are happy to have you all here. And our webinar for tonight is an exclusive event only offered to our very special guests who were some of the first people to get access to AAII Growth Investing. You'll be able to ask Wayne and John anything you want about the product, portfolio, strategy, first editions, and so much more. But before we begin, I do want to introduce myself. My name is Jenna Brashear, and I'll be your host for today. Now let's go over a few important points before we start. I do want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And if you have questions for our speaker during the presentation, please submit them using the question section of your GoToWebinar control panel. Our moderator will select questions submitted and read them aloud for the benefit of all watching the broadcast. And if you still have questions after the event, feel free to email Wayne directly at wayne@aaii.com. And we'll have that later on so that you'll be able to access that easily. And if you experience any issues with the audio or video of the webinar, please consult the instructions on how to change your device's settings or consult the GoToWebinar website for support at gotowebinar.com. And for new viewers, we always like to give a little background about our organization. The American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And so with that, I'd like to hand over the presentation to John.
Thank you very much, Jenna. And for all of you trivia buffs out there, I'm going to give you a little bit of factoid here. Jenna and I share the same three initials, JMB, which makes it very difficult when we want to actually use our abbreviations to communicate with each other. Thank you very much, Jenna. Jenna manages our community efforts, our branding, our social efforts. So she's always has her pulse on what you guys are interested in. And I'm here, the president of the American Association of Individual Investors. My name is John Bajkowski. My role is to moderate tonight. I'll be looking at your questions and passing them on to Wayne. And again, it's a VIP tour. Thank you for being VIPs. Thank you for your support of the association and its efforts over the years. And with that, I'd like to welcome Wayne Thorp. Wayne is the vice president here that is in charge of all of our research. And most importantly, over the last year or so, he's been doing a deep dive on how one can go ahead and use a smart, evidence-based, quantitative approach to building and managing a portfolio of companies that are growth focused. And tonight, Wayne is going to give us the keys to the kingdom that he discovered and give you a little bit of a highlight on what to look for in our website, how one goes ahead and builds a portfolio, and just as importantly, the kind of factors to consider when it comes to selling a stock. So with that, welcome, Wayne.
Thank you very much, John. Thank you for moderating this evening, and thank you, Jenna, for running the show. And welcome, everyone. So my name is Wayne Thorp. I wear many hats at the association, and as John pointed out, over the last year or so, I've been working on developing a strategy that hopefully is a way to maybe do growth investing, quote unquote, the right way. I want to give you just an overview of what we'll be touching on this evening. I'm going to start out and give you sort of a 30,000-foot view of the growth investing strategy, and then walk you through, probably what many of you are interested in is how do I actually build a growth investing portfolio? So I'll walk you through some steps on how you can do that. And then, just as importantly of knowing what to buy is also knowing when to sell. So I will talk about the sell criteria that I've implemented in order to allow you to fully manage your growth investing portfolio. Also, then I'll be walking you through a new tool that we've developed for growth investing, our Growth Analyzer. And then lastly, I'll give you just an overview of the growth investing website, some additional resources that you have available to you to learn more about growth investing. And then lastly, open it up to the floor for you, the attendees this evening, to ask some questions. But as Jenna said at the beginning as well, feel free to submit questions through the GoToWebinar dashboard, and John will be taking a look at those. So with that, let's get started. The question, especially looking at the market right now, inevitably I get the question, and actually I ask myself this question sometimes too, is, why growth now? And what initially led me down the path of trying to develop this growth-oriented stock selection approach, it wasn't the what, but it was the who. And the who are the people attending this evening, and those are our AI members. We continuously survey our members on an annual basis, and then through different NPS surveys and everything like that. And one of the questions we ask is, what is their preferred investment style? And over the years, consistently, nearly half of our members state that growth is their preferred strategy. So, looking at that, our members are very much interested in growth investing. So, we know that then there's a need and an interest amongst our members. So then what we did is we looked at our current portfolio, our current stable of premium portfolios. We have the model shadow stock portfolio, the stock superstars report, dividend investing, and VMQ stocks. And really, though, amongst those portfolios, we really don't have what I would consider to be more of a sort of a quote unquote pure growth portfolio. So, we have an interest amongst our members. We have had a hole in our offerings. So this led me down the path of trying to develop this portfolio, this approach to satisfy the needs of our customers and our members, and do so following AAI's long history of being evidence-based, education-based, etc. But what I'm looking for, my goal is really to look at a growth investing approach that overcomes many of the shortfalls that befall many growth-oriented strategies. What I found was, you try to avoid the highest growth on an absolute basis. You don't want to, the best and the brightest when it comes to growth isn't really something that's going to provide you good long-term returns. There's a wealth of academic research and real-world results that bear that out. Also, we're looking for companies that have a history of profitability as well as cash flow generation. And then lastly, identify fundamental factors that indicate quality growth going forward. So, that was what led me down this path, and what the results of literally probably the last year of work, myself, the different analysts, our research interns, our programmers, our editorial department, a group effort is AAII Growth Investing. And really, there's two cornerstones when it comes to the growth investing strategy. I've been involved in quantitative stock screening, quantitative stock analysis for over a quarter century now. It's hard to believe it's been that long, but I have developed in a lot of stock screening strategies, keenly interested in the whole methodology of quantitative stock screening. And any good strategy always has a couple of one or two sort of cornerstone elements that you build the strategy around. And when it comes to the AI growth investing strategy, those are the growth grade and the Monraham G-score. And now the growth grade, it's the A+ growth grade. We use that for the growth investing strategy, but it's also part of the A+ investor platform. The growth grade rewards companies with strong and sustainable growth. As I said earlier, you don't want the best or the highest growth. You want growth that's strong but sustainable over time. And our growth grade also rewards companies that have a history of annual positive cash flows from operation, as well as year-over-year sales growth. So that's the one element, the one key element of the AI growth investing strategy. The other is Monraham's G-score. And this was an 8-factor model that was developed in an academic study back in, I think, around 2004. And it uses financial statement analysis for analyzing growth companies. And the G-score is a means of evaluating the quality of a company's growth prospects by looking at elements of profitability, operating stability, and accounting conservatism. So, we have the two main elements, the G-score and the growth grade. And then from that, we started hanging additional elements based on additional testing that I performed in this. So we start off, we're looking for a G-score or 7 or 8. The academic research as well as the back testing that we did here at the association shows that a company, the higher the G score over the long run, higher G score companies have higher performance. So we look for a G score of at least 7 on an 8-point scale, so a 7 or 8. We also look for a growth grade of 8. That's a score of 81 or higher. We also have done back testing that shows over the long term that when you go from an F to a D, D to a C, C to a B, and a B to an A, so at every higher level of grade for the growth grade, these companies also have better performance. So we're looking for a G score of 7 or 8, a growth grade or A, and then on top of that, we're also looking at the quality grade. The quality grade is also part of A+ investing, but this, it's a way of really what we found is when you're looking at the quality grade, it's more beneficial to sort of kick out the garbage. So, by overlaying this, we're adding a level of quality, no pun intended, but really what we're trying to do is just more jettison the stocks that are more prone to blow up and bring down your portfolio. So here we're looking for a growth grade of A or B, which is a score of 61 or higher. Now, on top of that, I also look at positive year-over-year sales growth. We'll be talking about it a little bit later, but one of the sell rules for the portfolio is if a company has year-over-year sales declines for 4 consecutive quarters, it's removed from the portfolio. So I just want to give sort of, a company is already on the right path, and it's had at least 1 consecutive quarter of positive year-over-year sales growth. We also look for positive trailing cash from operations. And we don't really focus much on earnings with the growth portfolio. Earnings, especially GAAP earnings, is more of an accounting measure. In the long run, really a company that consistently generate cash organically is more apt to do well and survive than a company that's just able to generate, this accounting measure of earnings. Then, like all of our other portfolios, whether it's the VMQ portfolio, dividend investing, SSR, we also have minimum market cap and liquidity requirements. The companies have to be up to date in their SEC filings, so that means that the data we're relying on to select companies is up to date. And then lastly, we exclude OTC stocks. They tend to be rather illiquid. They don't necessarily follow as stringent reporting policies. We also omit REITs just from a taxation and accounting standpoint. And then just, in the geopolitical environment we're operating today, we also exclude Russian and Chinese firms. So these are the
Wayne,
Yes,
just a
sir.
quick. So you have the slide deck that's available as a handout. So I think if you advance one slide to slide 6.
I'm sorry. Yes, I thought I had. I apologize for that.
No worries. So again, anybody who's listening in on the webinar, please feel free to download or view the PDF. Some people like to write things down. Some people prefer to have a view of the slides up on the screen as well. So please feel free to follow along with us on our slide deck. And I think at some point in time, Wayne is going to go ahead and probably open up the website as well to show some of its analysis. But I just wanted to let everyone know who's listening here that the slide deck is available.
And with bated breath, I'm actually going to do that right now.
And so while you're doing that, Wayne, I've got a question here from Ralph. So when selecting a company for the portfolio, do you use any expected future EPS, revenue, or other guidance from Stock Investor or any other sources?
No, we do not look at forward earnings, revenue estimates, anything like that. We look for companies that have a long-term history of strong but sustainable earnings growth, positive cash from operations generation, as well as year-over-year sales growth. And then the G score is using analyzing different elements of profitability, stability in a company's year-over-year sales growth and profitability, as well as accounting conservatism, and looking at elements that in the short run might depress those GAAP earnings that we've talked about. That'd be capital expenditures, research and development, and advertising expenses. But in the long run, these expenditures actually might benefit the company. So we're looking at companies that are actually spending more on those different elements as a percentage of assets. So
Interesting.
all we're looking at is historical accounting data, no future estimates or anything like that.
Thank you. I'm gonna let you log in, and while you're waiting for the login to occur, I'll ask you one more question once you go ahead and log in. Is there a minimum capital requirement for a stock?
I've implemented I think it's a 300 or 400, I think it might be a 400 million, sort of trying to follow the shadow stock just from that minimum level of liquidity.
Okay.
But I found that the companies, because of the long-term operating history that they have to have and the growth behind them, I think, I have not yet to find a company that I would exclude because it doesn't meet those minimum market cap requirements.
Yeah, and I know that I have Mark here noted that he was surprised to see that 4 of the first 10 stocks in the portfolio that you're going to show us here had a quality rating of B or so as opposed to A. And I guess I'm going to actually probably touch upon this, but I know that, you know, we also, when looking at the VMQ portfolio, we did some testing on that. And again, we found that the highest quality stocks, as you noted, don't necessarily perform better than the rest of the market, but you want to avoid the really low quality stocks. I think that's what you're doing with your strategy as well.
That's correct. Yes. So yeah, we look at A and B stocks. We're not looking at the absolute highest quality, but yeah, it's the quality grade is more useful to exclude the sort of the stinkers with the lowest quality grades. And actually, a sell rule. I'll be talking about this a little bit later as well. But one of the sell rules for the portfolio is if a company's quality grade falls to F, it's removed from the portfolio.
Very good. I'm going to go ahead and slide in the background and let you continue on. If I get any more questions, I'll interrupt you if you don't mind.
Nope, no worries. So now we're going to get into, how can you go about, oops. How can you go about building your own growth investing portfolio? So, it was the last couple of weeks have been, rather tense for me. John and I actually had this conversation. He's like, I've never had kids, but this is probably the closest that I'll ever come to sort of birthing something. I spent a year of my life, putting this together, and so when we finally sort of flipped the switch last Wednesday, and actually started building this portfolio and actually making the trades, it was very, very nerve-wracking, but at the same point in time, very exhilarating. So last Wednesday is when we turned the portfolio on, and we actually started making real money trades for the portfolio. So here, and hopefully, can you see the growth investing website, John?
Yes, we can see that. We
Excellent.
can see everything perfectly. Thank you.
So here you see the current portfolio holdings. So when we're fully invested, the growth investing portfolio is going to have 20 stocks in it. And we're halfway there right now. We've made 10 purchases for the portfolio. So at the portfolio holdings tab of the website, if you go to the portfolio sub tab in holdings, you can see the companies that are currently in the portfolio. And we have select data here, the growth grade, the growth composite, the G-score. But one of the elements that you probably want to key into, especially if you're looking to start building your initial portfolio, is whether or not a company, make this a little bit bigger, is whether or not a company currently qualifies. And so you see here that all of the stocks currently in the portfolio still have that green check mark that indicates that they currently qualify, which makes sense. Hopefully, we've only been doing this for a week now. So hopefully these criteria aren't changing too much. But if, inevitably in several months from now, a company hasn't met our sale requirements, but doesn't necessarily meet all of our initial selection criteria, their check mark might fall off. But if you're looking to start adding to your portfolio, I would suggest start with our current portfolio holdings, and then start with those companies that currently qualify. When I am looking to select stocks, I always start with the G-score. So I start with stocks that have the highest G-score. And then from there, I look at the growth composite, and sort that by the raw score, because an A can range from 81 to 100. So I start then with the highest growth score. Now, inevitably, people are going to ask, how, and we'll show this in just a minute. Actually, we can do this right now. So you have your current portfolio holdings, but another element of growth investing is we also have what is called the growth ideas listing. Now, the ideas list are companies that meet all of the initial criteria in order to be considered for the growth investing portfolio. And this listing is updated on a daily basis. Currently, we've got probably 40 plus ideas in here. But you can see that we have one company with a G score of 8 that has not been added to the portfolio yet I've added stocks that have a G score of 7. Another wrinkle that I hadn't thought about when we were getting to the point to actually launch this is we're also launching in the middle of earnings season. And was a longtime manager of the SSR portfolio, and experiences have taught me that I personally try to avoid transacting in stocks, especially buying stocks for my portfolio, SSR growth investing, is to buy a stock, less than a week before it actually announces its earnings. So that created a little bit of tension and headache too, was trying to, was identifying a ton of stocks that were eligible to buy, but then, looking to see when they're announcing. So, there was a lot of additional things to consider as we started launching this. But, when you're looking to either I'm doing my analysis to add stocks to the portfolio, or if you're considering stocks to add, I would start with the G score. I take that back. Start with the companies that currently qualify. So again, at the portfolio listing page, that currently qualifies, then G score, and then growth composite. So, you've got 10 stocks. I'd recommend probably starting out with a portfolio of at least 10 stocks. That should give you sufficient diversification. But if you are interested and you look at this list of initial 10, I'll be adding 5 more stocks on Friday, issuing another edition alert on Friday, and then additioning the final 5 will be announced a week from Friday. But if you are interested in investing in stocks outside of the current portfolio and look at the ideas list, one thing to keep in mind is that the stocks that are on the ideas list, they meet all of the criteria that would lead me to add them to the portfolio, but there's no guarantee that they will actually ever end up in the portfolio. So if you do buy a stock from the ideas list, keep in mind that it's up to you then to keep a look at all of our quantitative sell rules, and it's going to be up to you to make that sell decision if a stock doesn't actually end up in the portfolio.
So Wayne, when it comes to building a portfolio, I've got a couple questions here.
Mhm.
Do you normally, let's say you're going to invest 100,000 and you want to have 20 stocks, would you equally weight your position? So let's say you're investing today, would you just do the $5,000 position now, or would you modify it over time?
So if you're, realist, you don't have to buy all 20 today. We're still buying. We're going to be investing, getting fully invested probably over a course of about 2 or 3 weeks. So you don't have to rush in and buy all either 10 or all 20 at any point in time. But no matter if you're not going to be adding money to your portfolio, whatever amount John threw out, $100,000. So if that's the case, then you'd be looking to invest roughly $5,000 if you're buying all 20. You're looking to invest roughly $5,000 in each of the 20 stocks, or if you're investing in 10, then it would be $10,000. But the key is equal dollar amounts, not equal share amounts. And so it doesn't matter if you're looking to buy. If you're buying stocks today, but then you're not going to be buying more in 2 weeks, definitely just keep in mind, keep that equal dollar amount. Inevitably, as the portfolio moves, if you do invest over the course of a couple of weeks, your portfolio weightings might be a little off. So if you're buying 20 stocks, then that would be a 5% weighting. If you're buying 10 stocks, that'd be a 10% weighting. That's don't be surprised if that happens. But definitely the key is equal dollar amounts. So yes, excellent question.
And just to follow up on that, so is this a long only thing? A member was asking, are you going to do any short recommendations?
This is a long only portfolio. That is correct. Yes.
And as if someone wanted to balance out the growth element of investing and they wanted to maybe look at the ideas list and check on value, there's nothing wrong with that. Just that that'll be, like you said, managing on their own.
That's correct. Yes. So I mean, yeah, I mean, if I'll be talking about this a little bit later, but one of the things you'll inevitably see if you start looking at these individual companies is, these are growth companies, and one of the knocks oftentimes of growth investing is the fact that these companies tend to have very high valuations. But that's not to say, if you want to overlay, using the A+ value grade or any other, individual, metric, PE, price to book, whatever, you know, just be prepared, because I have looked at this myself. You're not going to find, this is not a growth at a reasonable price portfolio. Almost exclusively because of the underlying fundamentals of these companies, they are going to have some pretty steep valuations. But I have a very interesting slide that I want to show later that at least for me allays a lot of the fears when it comes to investing in high valuation companies.
And just one more question, then I'll fade into the background here for now, and I'll be answering some of these questions directly in the queue that I know. So we have a lot of volatility in the marketplace now, and let's say there's alert comes out. Should someone should you act right away? Should you take your time? Any in terms of keeping your sanity as far as making transactions and having a good process in place for actually executing?
My what I honestly try to do, I mean, short answer is you don't have to act immediately. This is a long-term portfolio. The back testing that we did leading up to this, our average holding period was well over 2 years. So, this is a long-term portfolio. That's what it's designed and to be. So, whether it's you transact, 1 or 2 days after the alert comes out, or 1 or 2 weeks afterwards. If you wait, especially, I'm not a market timer. Don't pretend to be, but my personal rule of thumb, and it's become a little bit of an obsession for me over the years, is I always try to transact at a price on a. I try to buy at least at or below the alert price, or sell at or above the deletion price. That's just something that I've developed over time. But as far as whether it's within 1 or 2 days or a week or two afterwards, there is not a lot of pressure to transact immediately. So that'll allow you to, if the market has been in a little bit of a down rut, you might be able to get in at a slightly more attractive price, or if the market's in a bit of an uptrend, you might be able to squeeze out a little more performance to the top end before you sell. So you do not have to transact immediately. And also, these stocks tend to be, larger and more liquid, so you shouldn't see a lot of volatility around an alert as well. So, talked about how you can go about building a portfolio, but also touched on the fact that, we will issue additional alerts, and then at some point down the line, inevitably, there will also be deletion alerts. And as a subscriber, either a platinum or a growth investing subscriber, we issue addition and deletion alerts. So you might have been last Wednesday or on Monday, you might have received an email alerting you to the fact that I'd made some portfolio additions. So here's an example of the portfolio addition alert that came out on Monday. The email is very similar. It gives you the companies that are being added to the portfolio, as well as a decent write-up as far as what the company does, any risks or sort of unique attributes of the company that might make it attractive, and then sort of walk you through the different elements, looking at the elements of the growth grade, the elements of the G score, its quality grade, etc., to give you an idea of these companies. This is not a black box system. Very much what we're trying to do here is educate individuals on how they can use a quantitative system to select and manage a portfolio of growth-oriented stocks. But then we also want to educate people at the individual company level and provide you with the information that we looked at when we were making these transactions. So as we move forward, you'll be an additional alert will go out sometime on Friday, and then another additional alert will go out sometime the following Friday. So let's see. So I just want to see if I'm covering. So we got our. So okay. So when to sell? So we talked about how you can go about buying into your growth investing portfolio. I've been investing now for 25 plus years. It's very easy to buy a stock, in my opinion. When it comes to sell, it's very easy to second guess yourself, and decide, is it going to come back? If you're looking at price performance, is it going to come back? Or, should I hold a bit longer, maybe get a little more on the return on the upside? I found that just as quantitative buy rules remove the emotion, if a company meets the criteria, then I'm going to consider it for a buy. If it doesn't, then I'm going to move on. The same thing on the sell side. You have a set of hard and fast rules when it comes to decide when it's time to sell. It makes things much easier, especially when the market is going through a period of increased volatility. It removes, you might have a price performance element to your sell strategy, but if you don't, and if the stock's going down because the entire market's going down, that's not the end of the world. Everything else is going down too. So if that's not part of your sell strategy, then you don't have to worry about it. So just on the buy side, had a very explicit set of criteria to look at when we're buying a stock. We also have a very explicit set of criteria that if a company exhibits these, then it's time to sell. And again, the top two sell rules are the G score. If the G score falls to 2 or lower, and again, it has to be 7 or above to be considered for addition, then it's removed from the portfolio. If the growth grade falls to D or lower, that means that the score has fallen from 41 or lower, from 81 or higher in order to be considered. Pardon me. History will show that 2 more should be coming. I sneeze in trios, in threes, so hopefully they won't. If the quality grade falls to F, that means the score falls below 21. It's also removed. If negative year-over-year sales growth for 4 consecutive quarters is negative, it's removed. And then lastly, we do have a performance benchmark, but that's so it's at the 3-year mark. So we don't even start worrying about the performance in the portfolio until a stock is held for 3 years. At which point, once it hits that 3-year anniversary, we start looking at a stock and whether or not it's outperformed or underperformed the benchmark. If we've held a stock for 3 years, it hasn't hit any of our other sell criteria, but it's underperforming the market. In this case, the iShares Core S&P 500 ETF or the IVV ETF, we remove it. At some point, that probably indicates that either our analysis wasn't correct, or something just might not be clicking with the market. That happens, and chances are there's probably stocks that are passing the strategy that have greater opportunities now. So you're sort of eliminating any opportunity cost of holding on to underperforming stocks in the long term. But again, that's at a 3-year mark. And actually, I realized too, one other sell rule that we have, it's not really a sell, but we do rebalance periodically. And that's if the weighting of an individual holding gets to be 2.5 times above the average holding size, then we'll pare that down to bring it more in line. We won't sell the whole position, but we do want to make sure that an individual holding doesn't become too big and be too outsized in its impact of the performance over time. So that is one other additional element that we do look at on the sell side as well. So we talked about, within the construct of we identify with the portfolio holdings list, you can go there and see that these are the stocks that we currently hold in the growth investing portfolio. We have the ideas list. So these are stocks that out of the 6,000 or 7,000 companies in the stock universe, these are the 40 or so that meet the initial criteria for consideration within the portfolio. But we also have built what we call the growth analyzer. And this is really a good way, it allows you to take a deeper dive at stocks that might be in the portfolio or in the ideas list, so you can learn more about it and how it fits within the construct of the overall growth investing approach. But also, inevitably we have our own portfolio of stocks, our own watch list. And with the growth analyzer, you can enter in a ticker and do your own analysis and see how an individual company fits within that. So let's see if I can get it. So at any growth investing page, you've got two search bar. You've got the search bar at my portfolio. If you do a search here, this will load a growth analyzer within the construct of growth investing. Now, the stock I'm going to look at is Hershey Company, not because I'm a big chocolate fan, because actually I tend to be more of a savory person. But when you think of Hershey, you might not think of it being a growth company. So trying to how is Hershey Company really a growth company? So we're going to pull up a growth analyzer for Hershey, and so the first thing we see is HSY, which is Hershey, qualifies for the growth investing portfolio. That means that it's on the ideas list. And if you go back and look at the ideas listing, Hershey Company is on that. Also, then, if a company is held within the actual growth investing tracking portfolio, you'd also get a notification there, something to the fact that HSY is in the growth investing portfolio or something like that. So with the growth analyzer, you start off with the AAII Growth Investing report card. So here we're looking at the two key elements of the growth investing strategy, the G-score and the growth grade. So we can see that Hershey rates a 7 on the 8-point G-score scale and has a growth grade of 89, which again has to be 81 or higher in order to be considered. So it's an 89, which is an A, which is very strong. From here, then, you can scroll down, and we then break down the analysis of the company, both at the growth grade level as well as the G-score level. So as we said earlier, Hershey has a growth score of 89. That means it ranks in the 89th percentile amongst all U.S. listed stocks when it comes to its growth score. Now, in order for a company to qualify, as I talked about earlier, a company has to have a growth grade of 81 or higher. But what goes into the actual growth grade? And there's actually 3 elements we look at. We look at 5-year sales growth, year-over-year sales increases, as well as the company's ability to generate positive cash flow on an annual basis over the past 5 years. And when we're looking at sales growth, I keep alluding to the fact that when you're looking for growth stocks, you don't want the highest absolute growth. You want growth that's going to be sustainable over the long term. And actually, I did analysis that showed that if you look at the 5-year sales growth rate for a company, the companies that are in their top 20% in terms of its 5-year annualized sales growth, and the bottom 20% as far as annualized 5-year sales growth have almost the exact same performance, which is abysmal over roughly about a 15 or 20-year backtesting period. What we found was that it's companies more on that sweet spot. So the companies that are in that middle 60% of the entire stock universe when it comes to 5-year annualized sales growth, those are the companies that perform the best. So I created a composite that actually rewards companies that punishes them for having either the absolute worst or the absolute best sales growth, and then rewards those that are in that sweet middle spot. So we look at that. We then look at year-over-year sales increases. So basically, the more over the last 5 years, so the more if a company has been able to generate annual sales growth over each of the last 5 years. It gets the highest composite going into calculating this. Same thing with 5-year annual cash from operations over the last 5 years. Companies that have positive cash from operations over the last 5 years get the highest composite, and backtesting shows that these companies perform better than those companies that have, either 4, 3, 2, or no positive cash flow at all over the last 5 years. So those elements we look at, we create a composite, we average them together, we rank them, and that's how we come up with the growth grade. We then look at, so that's how the first element is the growth grade, and then we look at the G-score, and again that's an 8-point scale looking at elements of profitability, stability, and accounting conservatism. And at the profitability and cash flow level, we look at return on assets, cash flow return on assets, and accruals. And when there is some type of a comparison, all of the comparison is done at the industry level. Many of these ratios are very industry specific. So, we're comparing a company's return on assets to the median of its industry. So in this case, Hershey has a return on assets of 15.9%, whereas the median ROA for companies during the food processing industry is only 1.4%. So Hershey's return on assets is above that of the industry median, so it gets a point that is calculated and added together to arrive at that potential 8-point scale. So return on assets is net income over assets. Cash flow return on assets is looking at a company's cash from operations relative to its assets. So it's just a spin on return on assets, but it's again looking at cash flow, which I think is perhaps a better indicator of a company's long-term prospects, a company that's able to generate organically positive cash from operations, as that means its operations are able to sustain it going forward. So just like with return on assets, we're looking at Hershey's cash flow return on assets is 24.5%. Now, compared to companies in its industry, the median is only 1.1%. So again, Hershey's will receive that check mark. It gets 1 point for this. Then we look at accruals. Accruals are a way of sort of measuring sort of the quality of a company's earnings. Now, if we find companies that have net income that's significantly higher than its cash from operations, that tends to mean that there's been a lot of adjustments to net income sort of on the back end. A lot of these adjustments are at the discretion of management. And when you find that net income is significantly deviates from cash from operations, that tends to mean that the quality of a company's earnings are not as good as it could be. So in order for a company to get this check mark, its cash from operations has to exceed its net income, which is the case again for Hershey's. So at the profitability and cash flow level, Hershey's passes 3 of the 3. So currently we're at 3 points. Then we look at variability. And here we're looking at earnings variability and sales growth variability. And in this case, we look at the return on assets for a company over the last 5 years and create the variance, which is basically how much an individual variant deviates from the average of those variables over the period you're looking at. The higher the variability, that means that earnings tend to fluctuate over time. Increased volatility, increased variability tends to mean the company's operations are more volatile, so it's not as a stable company. Same thing with sales growth variability. We look at year-over-year annual sales growth over the last 5 years, and companies that are consistently being able to grow its sales on an annual basis, at roughly the same clip versus, it's up 5% one year, down 10% one year, up 30% the next year. Same thing. If a company's variability in its annual sales growth is low relative to its industry, that means that tends to be a more stable operations. In both instances, Hershey's earnings variability and sales growth variability are below that of its industry. So we see 2 more check marks. That means then we're on a path of 5, I believe, 5 out of 8 currently for Hershey's. And then lastly, we look at accounting conservatism. And I alluded to this before. Accounting conservatism, ultimately, we're looking at elements that a company that can sort of diminish a company's net income or earnings per share in the short term, but actually in the long term might be beneficial to the company. So, if you see a company that's spending a lot on research and development, if the company is, if its research, if its R&D department is efficient, um, then that money being spent should lead to new products, new enhancements, things like that. Same thing with capital expenditures and advertising intensity. A company who is able to successfully and efficiently spend its money on advertising, probably leading to increased sales, which then would lead to higher top line growth, as well as, and that should trickle down to higher earnings growth. So we look at the quote unquote intensity of research and development, capital expenditures, and advertising. And all we're doing is looking at the trailing 12-month expenditures for these 3 elements relative to the company's total assets. So it's R&D to total assets, CapEx to assets, and advertising intensity to assets. And if a company is spending more on R&D, CapEx, or advertising relative to its assets, if it's spending more relative to its industry, then it also gets a point. In this case, we see that Hershey gets a check mark for capital expenditures and advertising intensity, but we'd see that Hershey's does not report R&D development expenditures for the trailing 12 months. So at the best it could do then was get a 7 on the 8-point scale, because it does not report. And so it doesn't report, so it doesn't get that. So then we walk, so this discusses all of the individual elements of the G score. So you've got the growth grade elements and the G score elements that are part of the overall growth analyzer analysis. So I'm not sure, John, if there's any questions about the growth analyzer. I know we're getting a little long here, so.
There's plenty of questions. I guess there's always it's like you said, there's a fine line between how much more you want to show, whether or not you want to stay late to answer questions.
Sure.
I'll just throw a couple quick ones out here, as long as
Okay.
we're asking. Did you find any significant anomalies over the last few years due to the pandemic and the investment process during some of these disruptions that occurred?
I think the biggest thing was, it was the impact of the pandemic on the way in which companies operated. And I think it pulled forward a lot of innovations in companies that might have happened, but it sort of jump started things. It's everyone. A lot of people were using Amazon prior to the pandemic. Probably a lot more people are using Amazon now. Something as simple as curbside pickup. Almost every Saturday morning, I now go and pull into the parking lot at Walmart and have somebody bring out my groceries to me and load up my car, and I go home. I don't set foot in a store anymore. Uh, you know, I was a user of DoorDash, Grubhub, but use those all the time now. I'm staying downtown tonight. I'm staying downtown. I live in the far western suburbs of Chicago now, but I'm staying downtown tonight. Inevitably, I'm probably go back to the hotel and order something from DoorDash. So, I mean, that's what really I discovered. Obviously there was tremendous market fluctuations. There was that initial crash when things started to shut down, the market really dropped. Then as things started opening up and we got some encouraging news, we started getting a vaccine, everything like that, then the market really took off again. So, definitely added volatility to it, but I think that the impact was more on how companies, really the fundamental way in which companies operate.
And I guess when you're looking at a company like Hershey, which has potentially a family ownership or a foundation behind it, do you ever look at things like insider ownership or privately owned shares or things that might impact the float?
I mean, I look that's I don't, I sometimes I'll look at if a company has like multi-class shares, just want to get at least an understanding of what the voting rights are and things like that. Obviously, if that impacts, if it's so closely held that it impacts the liquidity, then that would sort of fall off because of our other liquidity rules. But I really don't, I mean, outside of, MLPs, and structures like that, really don't make a big distinction when selecting stocks.
And I'll ask one more big question here before I let you continue on. We'll obviously get back and answer these at the end of the webinar. A lot of questions came up regarding sector considerations when building a portfolio.
Mhm.
What do you have any? What do you do personally? Are you looking at sectors to build this? Are you trying to diversify by sector? Do you have any recommendations along that way?
Obviously, diversification benefits come from investing in stocks that have similar returns but don't move in the same manner. So they have a low correlation with each other. And so, you achieve partly some of that lower correlation by investing across sectors and industries, as well as styles as well. But in this case, since we're looking at growth stocks, so, here's where we're at currently with the portfolio. So you can see here, it is, somewhat, well, we can start at so we got some consumers, cyclicals, consumer non-cyclicals, healthcare, industries, and then a lot of tech. Those are the nature of a lot of growth companies right now. So, we are trying to achieve some, there is some automatic diversification just because the companies, they're not all tech companies that are passing. They're not all healthcare companies that are passing. I don't make I don't necessarily making a conscious effort, but I certainly, if I started looking at stocks and realize that, wow, you know, I'm all the stocks I'm looking to buy are all technology companies, I probably would definitely pause and say, okay, maybe I need to think about this. But if you're looking at the ideas level, you got a good mix amongst consumer cyclicals, healthcare, industrials, and again, I mean, heavily weighted towards technology. But then even at the technology level, you've got, online services, on IT services and consulting. So, electronic equipment and parts and equipment. So even those, they might be in the same sector, but to the industry level, they're not necessarily moving in lockstep either. So that's probably that's that's how the that's how I look at diversification and whether or not I'm making you know decisions at the sector industry level. So, one thing I do want to touch on, there's two other elements that we look at when we're selecting stocks. Is the quality grade. So a company has to have a quality grade of B or better. This is more useful. Our back testing shows that especially at the F level, companies with an F grade significantly underperform. And quality in general is actually used more as an exclusionary factor. Again, sort of to kick out those stinkers. So we have the quality overlay. But one thing I want to touch on, as I alluded to, one of the criticisms when it comes to investing in growth stocks is the fact that these stocks tend to be have high valuations. And so, looking at the A plus value grade, so the A plus investing has 5 different factor grades: value, momentum, quality, estimate revisions, and growth. Um, and so these aren't part of growth investing, but if you're platinum subscribers, which I think a number of you are attending tonight, you would have access to these. But if you look at the A plus value grade for Hershey, it has a value score of 3. That means its valuation ranks in the top 3% of the most expensive stocks in the entire stock universe. And you can see why. It has a price sales of 5, a PE ratio of 33, shareholder yield of minus 40, price to book of almost 17, price to free cash flow of almost 60. So these are these are very high valuation companies. Again, shouldn't be surprised by that. But ran across some data about a year or two ago that, and I think I was giving a webinar a couple of weeks ago, And it's rare for me anymore to have sort of aha moments when it comes to investing or when I'm doing research. But this was a slide that actually gave me pause and was an aha moment for me. And this is data that comes from Boston Consulting Group and Morgan Stanley. And they looked at the drivers of uh, stock performance for the S&P 500 companies from 1990 through 2009. And they looked at it on basis of holding period as well as 4 elements: free cash flow, multiple, margin, and revenue growth. And what they found that if you have a 1-year holding period, then the multiple, PE, price to book, whatever that might be, the multiple has a significant impact on the stock price, on stock performance. But once you get to the 5 or even 10-year holding period, the vast majority of stock performance is driven by sales and profit, which is what we're looking at for the growth investing strategy. So again, as I alluded to and mentioned before, we're looking for this to be a long-term portfolio. So yes, obviously in the short term, investing in high valuation stocks can lead to some short-term volatility. But the longer your holding period, which is what we're intending to do with this overall portfolio, the valuation becomes less and less. So over 1 year, 46% of price performance was driven by the multiple, but then it drops down to 19% for a 3-year holding period, 15% for a 5-year, and only 5% at a 10-year. But at the 10-year level, so you got 75, 90, almost 90% of the stock's performance with a 10-year holding period is driven by sales, revenue growth, and its profit margin. So, obviously, it's investing in high valuation stocks can be a little nerve-wracking on the short-term basis, but looking at this portfolio, looking at this slide, and the fact that we are intending this to be a long-term holding period, hopefully will go some way to alleviate some of those fears. So, one thing I just want to touch on really quick, just going back to the website, is spend a lot of time developing a lot of user resources that help people learn about the strategy, build their portfolio, walk them through how to use the growth analyzer, everything like that. So if you go to the how-to section of the website, you have all of these different elements. You can learn more about the growth investing strategy. Coming soon, we'll be putting some videos. I created a quick invest guide, so very quick bullet points on how you can go about building your own portfolio, the considerations to make, talks about the portfolio addition and deletion alerts, et cetera, et cetera. So, hopefully we've done a good job of giving you the resources that you can become acclimated to and learn how to use the growth investing portfolio. And then lastly, I just want to talk about there's 2 articles that I wrote earlier this year in the journal that I think do a really good job of taking a deep dive into the G-score and the growth grade. So in the October 2022 issue of the journal, I did an article on the AAII growth grade. In the September 2022 issue, covered the G-score. So if you want to learn more about these 2 sort of cornerstone elements of the growth investing strategy, these are, I think, a really good places to start. So with that, I reopen the floor to questions, and thank everyone for their time.
Thank you, Wayne, and a lot of great questions here coming in. First of all, would you mind bringing up Hershey again on the growth analyzer?
Sure.
I think one of our members correctly identified that we might have a typo in the description there, the analyzer. And if you look at the CapEx intensity, the description of that, in this case, it gets a point because it's CapEx is greater than the food processing industry, but we're actually saying
That's
less than. So I think that's.
Thank you.
So we'll be sure to correct that. I think I'm sure Jen is listening right now and making a note. Now, a lot of questions came up into the notion of how does one integrate the growth investing portfolio into the other portfolios that are available through Platinum.
So, inevitably everyone has, most people, it's rare to find someone who doesn't say, I'm more of a value investor than a growth investor or whatever that may be. We have a variety of portfolios here at the association. We have the model shadow stock portfolio, which is a microcap value portfolio. We have dividend investing, which tends to be, obviously dividend paying, income generating portfolio. By their nature, these tend to be more value oriented. We have VMQ, which is factor based. So we're looking for companies with the intersection of high, low valuation, high quality, high momentum. And then we have the Stock Superstars report, which uses 4 distinct, unique strategies to sort of give you diversification at the strategy level. So, you know, the growth, and this is where I think the growth actually I think is easier because if you're looking for a growth element to your portfolio, this really satisfies it versus any of the other portfolios we have at the association. So if you're looking to invest in growth, try to integrate it within all of our other strategies, this is definitely where you want to look for that growth. But then, if you're looking for income generating companies, then that's where dividend investing comes into play. At the microcap value level, this is really the level where individual investors have the advantage. These are companies that high frequency traders, mutual funds, hedge funds, et cetera, they can invest. So at the microcap value level, it's someone that has the time, the discipline, and the education to manage a portfolio over the long term. They have a very significant advantage and can actually do probably better than a typical professional money manager. Then VMQ, that's if you believe in factor analysis, it's again the intersection of value, momentum, and quality. So there's the value, or so it's kind of trying to find value on the move with a quality overlay. Now that's Charles might not agree with that, but that's kind of how I view VMQ. So it's that value slant, but it's potentially alleviating some of the fears with value investing that you buy a value stock and it stays a value stock. So you're finding value stocks that have a level of momentum that might mean that the market is starting to recognize that the stock is undervalued. And then SSR, we use the O'Neill CanSlim approach. So that's price momentum, strong short-term and long-term growth. We use David Dremen, which is more of a sort of a psychological, a behavioral financial element strategy. So looking for low PE stocks that are also experiencing positive earnings surprise or upward revisions in estimates. We have the O'Shaughnessy, which is another factor. So we're looking at elements of value, financial strength, and earnings quality. And then lastly, one of my personal favorites, the John Neff approach. It's in his approach sort of ties in a little bit with the growth as far as he looks for stocks that are growing, but he wants stocks that are growing at a reasonable and sustainable level. So that's more of a growth at a reasonable price type approach with the Neff approach. So you do have a lot of different elements when you are looking, especially at the platinum level, but they are relatively distinct and unique. So again, you've got income, you've got growth, you've got sort of value on the move, and then you've got your smattering of either value or GARP approaches with SSR. So
Thank you.
probably a long-winded response, but
And just, I mean, I guess, and Helen here is asking, why, obviously, even value approaches do look for growth. So the issue is, do you focus on the valuation side or do you focus on the growth potential side? Is that kind of what the difference is with your approach versus a pure value approach?
yeah, I mean, and that's and one of the things realized too is, is doesn't matter what's whether value is in favor or growth is in favor. If you find us, I mean, I'd like to think that all of our strategies they're evidence-based, they're well-reasoned, they're sound academic and investment strategies. But it doesn't matter if value is in favor or out of favor or vice versa when it comes to growth. In almost any market environment, there's going to be compelling opportunities for either growth or value. So, again, I'm not a market timer, so I can't tell you if, the funk that growth has been in over the last, year or so, if that's going to change tomorrow. But at the same point in time, I'm also thinking if I develop a diversified portfolio that might be some in value, some in growth, et cetera, it's going to, there's going to be periods when certain segments of my portfolio are going to do better relative to others, and other times other segments of my portfolio are going to do better relative to others. So.
Thank you. And in terms of the environment in general, I guess a couple questions came up with, like here, there seems to be an inflationary environment. Any thoughts? I mean, I just saw an article today that noted that, the kinds of companies historically that have done well in a growth environment or non-inflationary environment, the need for having good profit margins, the ability to pass on prices to their customers, high growth, and consistency of growth are the kind of qualities that work well in an inflationary environment as well. Any thoughts on how the growth investing approach would work in a high inflationary environment?
At the cornerstone, what I've found is when you start running these screens, the companies that tend to pass this strategy fall into more of the category which is called secular growth. And secular growth is these are companies that doesn't matter, they're not completely insulated, but are much better positioned to be able to weather economic downturns. So that means they have a product or service that really, they're either industry leading or just, they are so pervasive in the lives of companies or consumers that, really can't do it without. Obviously, a lot of people I'm sure are scaling back their spending, but with the holidays coming, I'm sure you're going to still see a lot of brown Amazon boxes stocked up in front of people's homes. So it's companies like that, and these are the same companies then that probably have a product that they can pass some earnings increases onto. So these are definitely companies that are because again they're more longer term, so they're not as tied to the economic cycle. So yes, we're definitely in an inflationary environment, but the stocks that tend to pass, the companies that tend to pass this strategy, I strongly believe are probably better positioned to be able to weather any economic downturn versus a more of a pure cyclical growth company like an auto manufacturer or companies like that.
And I had probably a question slash suggestion from a member here. I'm guessing you're not going to do this when you're managing the model portfolio, but it's the whole notion of tax loss harvesting. So I'm guessing if you have a general decline in the marketplace and you're holding on to some stocks that are down, as long as you probably can go ahead and sell them and find similar passing stocks now, and in effect, you're harvesting those losses and investing it into a new stock. I'm guessing you're not going to follow that approach. There's certainly nothing wrong with that.
Yeah, that's something. Yeah, and that's actually a really good point. Is I think as a rule, no matter if it's SSR, DI, growth, whatever, we don't necessarily make investment decisions based on the tax implications. We let the strategy dictate where we go or the actions that we take. So yes, obviously, yes, in a down market, there might be that opportunities, but that's not something that I would be consciously doing within this portfolio. But I wish Derek was here because he could probably answer the tax questions better than I.
Understood. When it comes to other benchmarks, a lot of recommendations or requests are being put in to when you start looking at this thing over the long term, you consider how the performance stacks up to other types of benchmarks, growth, value, and whatnot. I guess people are just making that request to you, Wayne. So just keep it in mind.
I mean, I mean, I know Derek, I don't want to pick on Derek, but I know Derek struggles with the DI portfolio. Does he try to find some type of a more income oriented index? We looked at the S&P 500. It's an index that everyone knows. It's not a perfect index. Obviously, we're investing outside of the top 500. but we've used the IYY in the past, but it's not a benchmark that a lot of people know. It's a total market return. But so yeah, it's a struggle. It's we settle on the S&P 500 more probably because it's an index that people know, and it is probably the most pervasive benchmark.
And it's a request or an idea from a member here, but the whole notion of how can one use, or is there a special way to toggle the growth analyzer so that, or even if you have a portfolio view somewhere on our website, so that if you have a stock that you uh, acquired because it was a strong growth candidate, that it can quickly identify that it's now a sell candidate, that the sell criteria are quickly applied to in the growth analyzer as well, some sort of pop-up or some sort of notice, uh, kind of a idea for you, Wayne. I think it's a great idea for you to consider.
Two things I've been mulling over, and yeah, is either have a sort of a notes column similar to what we do for the shadow stock portfolio, when the growth score might be falling, the G score might be falling, or the quality score might be falling, or is to develop basically kind of an overlay for my portfolio that someone can load their portfolio and then apply this overlay to see the different elements and see how it stacks up. But yeah, excellent question, and something definitely on a future enhancement list.
In terms of, a number of questions came up here that, there's someone's a little bit older, they're retired. Is this approach suitable for someone who is older or retired, more retired or more conservative in their time horizon?
Obviously, I mean, at the end of the day, it doesn't matter. I mean, this is overarching. My first reaction and comment would always be, if there's either you're looking to retire, buy a new home, send the kids to college. If there's an amount of money that you're going to need in the next 3 to 5 years, shouldn't be in the market. Doesn't matter how old you are or what it's for. From there, then it's your risk tolerance and whatnot. But people are living longer, and I've read so many articles over the last 10, 15 years that one mistake that people have is that they go ultra conservative to preserve their capital, but they're not getting that capital appreciation that's going to see them through either their retirement, or if they're looking to leave money to grandkids or things like that. So obviously you have to the older you get, the shorter your time horizon. You inevitably are going to be making decisions as far as the overall risk of your portfolio. But even if you are in retirement or getting up there in age, you still want to make sure that you have enough capital appreciation potential in your portfolio. And this is what growth investing is. Any dividend income that comes from this stocks that are in this are completely incidental. This is basically a pure capital appreciation approach.
And just someone would like a clarification here. When you talk about when to sell, like the slide on, or the elements on slide number 10, you have
Mhm.
a series of sell rules. Does it simply have to meet one of those sell rules or all of those sell rules?
Just one. So, so the growth grade, realistically, it's not going to happen, but a company could still have a growth grade of A, but its G score could fall to 2. It's out of the portfolio. It doesn't have to be a growth grade of 2, a G score of 2, and a growth grade of D or lower. It's any one of those elements.
And it's 8:15 Central Time. How late did you want to go, Wayne? How many more questions would
Uh,
you like?
I mean, I'm probably getting near the end. Obviously, if there's any questions you think are worth asking, feel free. I guess, inevitably, I'm sure there's people dropping off, but I just want to refer, you know, I'd love to hear your feedback. You know, the only way, one of the great ways that allow me to make products better is, I get constructive feedback from subscribers. So, tell us how we're doing. What we can be doing, how can we make the product, or how can we make growth investing easier to understand or easier to use. Feel free to share those thoughts or comments with me. You can email them to me directly at wayne@aai.com. I'd love to hear from you.
Thank you. Well, I'm going to let you answer one more question then, since you offered. I
Okay.
had quite a few questions. They came up with the notion of rebalancing. Uh, how do you rebalance the portfolio, and do you have any tips on how often, or what triggers to use?
Sure.
Do you reinvest dividends, things like that?
So, I mean, so yeah, a few questions there. easy one. I do not reinvest dividends. Dividends are kept in cash that we can deploy when we make new additions down the line. As far as rebalancing, the only rebalancing we'll do for the portfolio is if a company's average if its portfolio size gets to be more than 2.5 times the average position size in the portfolio. So if a company, if an individual holding really becomes outsized relative to the other positions in the portfolio, then we'll scale that down to more, probably like maybe no more than maybe 20% above the average holding. But that's the only real rebalancing we'll be doing, and that tends to happen on a relatively slow basis. So, I can't say, obviously, always looking at the portfolio. So, over time that it could pop up, but, I don't see myself, January of every year, that'll be the time to say, whether or not it's to pare down portfolio holdings or anything like that. But definitely it would be discussed in the weekly commentaries if a individual holding started to get to that point where we'd have to consider paring it down.
Well, thank you, Wayne. Again, great presentation. A number of the people commented here, and they thank you very much for the presentation. They enjoyed it, a lot of good information, and they enjoy how it was educational as far as getting to know the concept much better. And Jenna's going to tell us that I think, and this is answer another question here, this is being recorded, or has been recorded, and you're going to send out an email to everybody who registered, and they're going to get access to it probably tomorrow. Is that fair, Jenna?
Yep, exactly. You got it spot on. Tomorrow, probably late afternoon, we'll send out an email to everyone who attended. That'll include a recording link to tonight's presentation. It'll have the PDF handout, and then they'll also have links to other resources or anything that we find helpful that we can share with you. So, and then I just want to thank Wayne and John so much for guiding us through our new service, AAII Growth Investing, and answering such great questions tonight. I was floored to see how many came in, and it was great to hear all the answers. And I just want to thank everyone who attended. We are so happy you could join us tonight. And also, I did want to bring up, if you are interested in discussing growth investment strategies, as well as our new product, feel free to log into the online AAII Growth Investing community, which is pretty new. So there's only a couple members, but feel free to start posting your questions, comments, suggestions, any experiences you've had in the discussion thread on there. You can visit community.aaii.com to learn more. And remember to use your AAII login credentials to get in. And I posted this in the chat. I posted a lot of great resources in the chat. So if you want to scroll up and down, I posted the phone number that you can reach our member services at, Wayne's email, as well as our member services email address. But if you need help in navigating, the AAI Growth Investing website, if you have questions about the portfolio, additions, deletions, strategy, you can direct those questions directly to Wayne. And then anything about your membership, if you have questions about AAI Platinum, etc., then you can feel free to email members@aai.com. And yeah, with that, we wish all of you viewing good health, good fortune, and a great evening. Thank you and take care.
Thank you. Good night.
Jenna, John, and good night, everybody.
Yeah, thanks. Bye.